More on the economy and reaction. Thomas Hayes, we need him badly for this. Founder, chairman, managing member of Great Hill Capital. Good to see you. If you're piloting the plane and the Fed says what they said, are you pushing all the engines now forward at maximum speed? Because there really isn't anything to worry about. The Fed just gave you the biggest green light you're ever going to get.
Yeah, no question. I mean, what a difference a few weeks makes. You know, I've been very constructive on the economy and markets in particular going into year end. But on October 22nd, there was a major headline in the Wall Street Journal that said, quote, another Black Friday may be, another Black Monday may be around the corner. And I made a joke of that publicly. I said, well, there's only 2 Mondays left in the month of October, so they've got a 50-50 shot. And sure enough, here we are at all-time highs in the Dow. The Fed did, in fact, give the green light, but I think you have to be nuanced where you go chasing. And you can chase the higher-priced, high-multiple, large-cap stocks, or you can find incredible bargains in the mid-cap and small-cap that are trading at much lower valuations.
I love it. Look, anybody watching the show is probably a normal investor, I'm guessing. And if you're a normal person, you have what we call FOMO, which is you've been worried in January, you've been worried in February, you made excuses why you weren't going to buy certain things or certain sectors, and then you mentioned October where it got a little bit scary. But here we are. You've missed out probably on a lot of gains, and you've got 3 weeks left in December, and we all know what the answer is. When you're scared of missing out and you get greedy, you're going to buy almost everything. What are we buying? Okay,
so I would suggest being nuanced. Actually, earlier this week, 2 days ago, the market was up and basically all of the Magnificent Seven were down. That is a sign of broadening. That's very healthy. That's what you see in a bull market. When you have very narrow leadership, it's not the best scenario. Now that we have the broadening happening, large cap is trading at 19 times next year's earnings, a little bit above average, the historic average. Mid caps are trading at 13.9 times next year's earnings, and small caps are trading at 13.2. So we're focused on turnaround plays. They don't call me Turnaround Tom for nothing, Phil. We like VF Corp is a company that we own, and the reason we bought it, they have North Face, Timberland, Vans, Supreme, Dickies. It's fallen 85% from its pre-pandemic highs. They just got a new CEO. He did his first quarter, the kitchen sink quarter. His name is Bracken Darrell. He came from Logitech. When he joined Logitech, the stock was down 82% in 2013. Over the next 8 years,
all right, BF, right? That's your turnaround play. What
VF Corp? Yeah.
What happened to the jobs? What happened to the college payments that were due? And we're all supposed to be saving money, and consumer stocks were getting hammered. All those discretionary stocks, including the one you just mentioned, are all part of a giant basket that everybody was worried about. What happened?
What happened is you can never count out the U.S. consumer when they have a job, and somehow Jay Powell has navigated the holy grail, the immaculate disinflation, where he was able to bring down inflation without destroying the jobs market. And when Americans have jobs, they spend money, period, over and out. Never bet against that.
And then what's this about these 2 rate cuts that the Fed is, quote, hinting at because of the dot plot? I don't want to get too technical here, but the bottom line is the expectation now is for at least 2 rate cuts in 2024. What is that going to depend on? I guess you're obviously, if you're bullish, you're betting on that, if not more. But how should the average investor view this?
I'm bullish, and I'm betting on less than that. So they've got 3 in the dot plot for next year, and then they've got some more in 2025, expecting the Fed funds rate to be down to 3.6% by 2025. End of 2025. I'll take the over on that. I don't think they're going to need to cut as much as they think. I do think the economic engines are humming. And after maybe a couple of cuts, it might be a mid-cycle type of situation like 1995, where they can just let the economy run and they're not going to have to take rates down as aggressively as the market is pricing at the moment.
In other words, if the economy is strong, why do they need to cut, right? I mean, the whole purpose of cutting is that if you need to stimulate the economy, but if the economy is on fire, it doesn't make sense that the Fed would cut. Am I reading that correctly?
Yeah, there is a lagged effect. So they don't want to be too aggressively restrictive, particularly in the face of inflation coming down, which we saw in the PPI, which is a better forward indicator than CPI, which is kind of backward looking. PPI is a leading indicator. So I think they just want to get ahead of, because deflation is a much harder problem to solve than inflation. Inflation, we know what we have to do. Deflation can last for many, many years, as we've seen throughout the world over the last few decades. So I think what they're saying is, we're on it. We're not going to let too much disinflation kick in. We will be at the wheel, and the economy's fine.